with Bellwether, and then also Matt Mueller with First International Bank. And I know they're going to be talking, one of the questions earlier was on opportunity zones. I'm assuming this panel is going to talk a little bit about that. Danielle and Jim and Phil, I'm sure we'll have some comments on that. So Jim, why don't I kick it over to you, and we're going to just turn up your volume so you can start talking and take it away.
All right, thank you, Jeff, and thank you for the opportunity to present today. Wish I could be there in person, but cannot. I think we have a great panel. Danielle Lewis, she's on our team at Wipfli, and I've worked with Phil Colton for many years. So, and the other two panelists, I'm happy to meet you, and I know this is going to be a good one. So why don't we introduce ourselves? I'll start. I'm Jim Lockhart. I'm a partner at Wipfli. I'm based in Minneapolis. I lead our real estate sub-industry for the firm. Started out as a tax person, still am. And Danielle, I'll pass it to you.
Yeah, good morning, everyone. I'm Danielle Lewis. I'm a tax partner here at Wipfli. I focus the majority of my time in real estate and real estate transactions. I work in our national tax office, and I also lead our opportunity zone group. I wasn't on the panel this morning to hear what the original question was, so feel free to re-ask us at any point. Otherwise, I'll go to the next person on the panel.
Morning, my name is Mike Polinchuk. I'm with Bellwether Enterprise, based in Minneapolis, Minnesota. We have 26 offices nationwide, so we have a national lending platform. I personally have been working in the Fargo Moorhead for over 20 years, and I'm glad to be here.
I'm Phil Colton, partner with Winthrop and Weinstein in the cities. We're a law firm of about 150 lawyers. Well, it is the largest real estate law firm in the cities by number of lawyers. I'm chair of the securities department, do an awful lot of equity capital raising, represent most of the broker dealers in the Twin Cities, and I also represent a number of REITs in this region. I think the number is 8 or 9 at this point in time, and do an awful lot of equity work with developers and real estate projects.
Good morning, Matt Mueller with First International Bank and Trust, Senior Vice President, Senior Lender for the bank, been there for about 10 years. First International is about a $4.5 billion asset bank based out of Watford City. I think we got about 28 branches now, mostly in North Dakota, some in Minnesota, down to Sioux Falls, and a handful in Arizona as well. My role at the bank, I help oversee the business bank and commercial lending department.
All right, great. Well, thank you. Well, Danielle, why don't we start with you with some tax questions, and anybody on the panel, Phil, also, any chance to pipe in and add to anything that we talk about here. But Danielle, you and I have spoken on a number of panels towards the end of this year, and one of the biggest questions that come up is, what's the current legislation for tax reform look like?
Yeah, and that's a great question. So I'm sure, as a lot of you guys know, this year has been a bit of a roller coaster of what we think, the next, round of tax cycle is going to look like. And starting at the beginning of this year, it was pretty doom and gloom. We were looking at pretty high tax rates, a possible partial elimination of a 1031 exchange. It was kind of a lot of higher tax rates, poor impact to, high income earning folks. Currently, where the legislation sits, what we know is in the bill right now is the SALT cap increase is still in the bill. So what that means is, back in the Tax Cut and Jobs Act, they had eliminated how much state and local tax you could deduct in a year. Previously, subject to certain other limitations, you could deduct as many state and local taxes as you had in that year, and they capped it to 10,000, which severely impacted a lot of people's tax situations. Right now, they're looking at increasing that to 80,000. or 40,000, depending on if you're married filing separately. That would be a huge increase to a lot of people's tax positions because it allowed them to deduct those state taxes again at a much higher level. Currently, we're looking at various different states who try to create a workaround around this SALT cap by creating a pass-through entity tax, which has kind of created its own little challenges and nuances for us in the last year as well. So that's really one really positive change that we're hoping stays in the legislation. One piece that's not as advantageous is the increase in what income is taxed under the net investment tax rules. Currently, like if we were thinking of what gets this net investment tax called NIT for short, is the 3.8% on high income taxpayers. Currently, you know, the only people who really, the only type of income that would get taxed on this is interest, portfolio interest, dividends, short-term, long-term gains that are non-business. They're kind of looking to move that into trade or business income as well. So that'd be for, you know, married filing joint couples who earn more than 500,000 a year. Their business income can get this additional 3.8% tax that was previously always shielded from it. So that's a pretty, could potentially be a pretty big increase to people. Some positive things that, you know, kind of have been removed, at least from the latest round of legislation, is 1031 exchanges. Previously, we were looking at a cap at how much you could roll into a 1031 exchange and still be deferred. Currently, that's removed, hoping it's staying that way. There's a lot of lobbying around that, and we think it'll stick for hopefully this round, but if any of you guys tuned into our panel last week, I think the 1031s kind of have a target on themselves now, so we might continue to keep seeing 1031 exchanges and their removal, you know, every round of new legislation. So that's just something to be aware of in the future.
Is there anything, are there any big changes that, you know, we should be aware of or that we should be planning on doing, you know, now?
Yep. So the CARES Act had kind of suspended a lot of rules that are not advantageous to business taxpayers. One of the really big ones is the excess business loss limitations. So the CARES, so this got passed back with Tax Cut and Jobs Act, so back in 2017, applicable the first year in 2018. What this is the cap of how much business losses that you can use to offset the rest of your income. CARES Act had delayed it, and now it's re-implemented going forward. So what that essentially means is if the cap is 500,000, you have $600,000 of business losses, $600,000 of maybe normal, you know, ordinary income, say interest, W-2 wages, anything like that. In the past, you'd be able to offset that with your full $600,000 business losses because you had 600,000, you know, take away 600,000, you get to zero. Now that business loss is going to be capped at 500,000, so you'd end up with a net 100,000 income. That's just something that people need to be aware of because I think we're used to scenarios where in the past, you know, we could wipe away all of our other income, say by doing cost segs or something else, and not have to worry about maybe our other portfolio type income, but that is kind of a reality now and something we need to plan around. It's still not a huge impact. For example, the biggest thing that I've been looking into for this year is when people are doing Roth conversions. Say maybe they put a few different buildings into place. We did a bunch of cost segs. We need to make sure that the benefit of those cost segs aren't, you know, you're still going to get the benefit of it. Whatever is going to be disallowed is going to be carried forward. But we're making sure people's Roth conversions, for example, at the end of this year are going to be utilized to the extent that we're not creating, you know, income from it. So that's been a lot of planning that I've been doing towards the end of this year. I would say our normal tax strategy still makes sense. Doing cost segregation studies, 179D studies to break out the useful life of buildings into shorter useful lives is still a benefit. There's just more tax planning around it and making sure that you're getting the best benefit in the right year.
Well, how can you, what about the ability to carry back? Because, you know, under the CARES Act, we were able to generate tons of losses and carry it back 2 years and get refunds. Does that opportunity still exist?
Unfortunately not. So we no longer have NOL carrybacks. We do have NOL carry forwards. But yep, the last year of that was 2020 to kind of generate those losses and carry them back.
And what about, bonus, the ability to write off, shorter life property, 15 and 5-year property in the current year, in the year of acquisition? Does
Yep.
that exist?
Yep, bonus depreciation is still intact. It's set to sunset in a few years. What we've seen again and again from legislations, they continuously extend that. So we'll look to see in that year, if there's going to be legislation to extend it. But currently, 100% bonus depreciation is still applicable to 2021 tax year. So it's still a really great year to kind of write off any of those 5, 7, 15-year property that you're able to take bonus depreciation on.
Oh, and what about, can you touch on 179D and 45L? I mean, are those applicable for 2021 and 2022?
Yep. So 179D is going to be an energy deduction that you get up to $1.80 square foot based on different energy type items that you're putting into your new building. That's still very applicable. We see a lot of people taking advantage of that. 45L is a similar energy credit that's going to look for, residential type buildings that are less than 4 stories, and it amounts to, a 2,000-ish credit per unit. So it's a pretty good item. With 45L, it's always good to double check to make sure that you can utilize the tax credit versus 179D deduction, that you kind of get the full benefit in the first year. But both are still good tax planning tools to use, especially if you have a new construction.
All right, and one last question, Danielle. Opportunity zones. I know you lead the practice for the firm. Are you seeing a lot of activity still in those? Are people still forming them? Are they looking for investments? I mean, what are you seeing out there?
Yeah, I still see a good amount of traction. I probably have 1 to 2 new meetings a week with people who are looking to set up an opportunity zone fund, especially right now. So right now we're looking at one of the bigger deadlines with opportunity zone funds. So the 3 benefits of investing into a qualified opportunity zone fund are: you get to defer your gain that you're putting your cash into the fund for. You get a step up of 10% as long as you invest by 12/31/21. So that's the big deadline coming up. And then you get to permanently exclude the gain on the appreciation that you put into the fund. So if you had $100,000 that you put into the fund from, say, a stock sale gain, after 10 years, that's at $500,000. You don't have to pay tax on that delta of that $400,000. You always have to pay tax on the original gain that you're deferring into the fund. But yeah, the big benefit that will leave after this year is that 10% step up that you're going to pay on that initial gain. It's not a reason to certainly make a bad investment. Certainly make sure that you're investing in something that is a great, going to bring you a great return regardless of whether or not it's an OZ property or not. But it is just something to be mindful of, that if you do have an investment that you're kind of debating on whether or not you should do before the end of the year, that's something to look into. You need to make sure that your gain will qualify for the deferral and everything. But yeah, I still see a lot of traction. There still continues to be somewhat negative media around opportunity zones, and the data that they're collecting from it is still really hard. So for the most part, all we really know is data that is self-reported by qualified opportunity zone funds. So it's a little hard to gather, where the traction really is and what people are investing in. But for the most part, real estate continues to be one of the big qualified opportunity zone fund investment platforms.
All right, great. Yeah. I see a lot of activity out there. I have a number of clients engaging in them and looking for deals, just as long as the underlying deal makes sense. tax benefits is certainly, gravy or icing on that cake. Phil, why don't we shift
Maybe I
over
could
to you?
interrupt. Yeah, maybe I could just ask Danielle a question. Most of the Opportunity Zone Fund work we've seen have been what I would call more range deals where the equity capital comes from a family or one or two or three investors. And I know when the opportunity zones were put in place, the thought was there was going to be a rush of equity capital from all different sorts of sources, and that a lot of the opportunity zone funds would be syndicated. And I'm just curious, Danielle, from your perspective, is that true of what you have seen?
I would say, like, for the most part, what I work on are probably similar to what you're describing, maybe more the family, friends and family type deals. I in our private client service group, I've seen a lot of syndicated deals coming through from, brokerage firms and everything that our high net worth individuals are investing in.
Right.
But I would agree that I think I see the majority of them as the smaller friends and family type deals.
And the reason why I bring that up is I've been asked many, many times, and I'm sure you have as well, how do we go out and raise the $1, $2, $3, $4 million that we need for this property? It's in an opportunity zone. Isn't the money flowing in? And unless you're working with one of the bulge bracket brokerage firms that are syndicating big deals, for the most part, that money really isn't flowing in like was expected. And especially losing that last, once we trip over the end of the year here, we lose a little bit of the discount in the statute. So it's interesting to see how this is all evolved in opportunity zones.
Yeah, I would agree. And I think what a lot of people didn't expect too is, there's certainly a hurdle for people to get over. Like, I think a lot of people thought they could go start their own funds, get them syndicated and everything. And what I think a lot of people found is that they didn't have that background of starting a fund, and they had a really hard time, incentivizing investors to go into their first fund and then hold it for 10 years.
Right. And then just to switch topics, getting back to the tax piece to try to keep it all together. When the tax changes came out, it was everything under the sun that they were looking to raise income at the federal level. 1031 was on the chopping block. Capital gains was going to go up. They were talking about taxing promotes or carried interest at ordinary income rates, not capital gains rates, which they've talked about for 100 years. But what I found to be very, very interesting was there was a proposal to disallow IRAs from investing in private funds and basically require that all the IRAs that invested in private placements basically back those investments out. Now, that proposal got taken out of the final bill and I believe is still out, but it's interesting all the various different angles that they were looking at raising tax revenue. And I think it's important to keep that in the back of your mind, because I know when we're raising equity capital, one of the first questions is, can we bring in IRA money? And it's typically limited at 20%. And I know there's tons of funds out there that have IRA money in it. It's not in the tax bill, I believe, at this point in time, but as they keep giving more money out, we know that they're going to have to raise taxes. So I'd keep that in the back of my mind.
Oh, those are really good points, Phil. Thank you. Well, Phil, since you've got the microphone here, you've been involved in some very large UPREIT transactions this year. Would you mind talking about these, walking us through those?
Sure. We were involved in a very large UPREIT transaction this year. The buyer was a New York Stock Exchange public REIT, And we represented the management company that managed 19 multifamily apartment buildings, principally in the Twin Cities area. And we operated those 19 buildings into the public REIT. It was a $330 million transaction, and it required obtaining the approval of all 19 different partnerships or LLCs, which involved dealing with over 250 investors. The partnerships had been in place for years, and there was significant gain in the transaction. And it definitely was motivated by the transaction had been in works for a long period of time, but the increase or potential increase in capital gains definitely motivated the transactions. And it was very interesting. Obviously, it was a significant transaction. A lot of people were working on it for a number of months. And we signed the 19 contribution agreements and agreed to the 19 tax protection agreements in June and closed the transaction in early September. The interesting part about the transaction for me was there was a redemption option to the investors in the 19 partnerships up to generalizing 10% of the amount of the deal. And not that many people did, in fact, take cash in the transactions, which was interesting because people were concerned about capital gains going up. The other part that was interesting was my investors, my clients, the partnership partners received preferred partnership units in the UPREIT partnership of the public REIT. And the reason that was done as opposed to the normal UPREIT transaction, which you're aware you contribute your partnership interests for the partnership interests in the REIT's partnership. By taking preferred interests, we could fix the dividend above the public REIT's dividend and fix the exchange rate to get to the cap rate that our client was interested in getting at in the transaction. What was even more interesting to me was we basically pegged the price at a $70 per share stock price. And when we signed all the documents, the stock price was $65. September 1st, when we closed the transaction, the stock price was $101. And the investors basically made the extra $30 a share. Now they can't get that for a year before they can convert their preferred to common and then convert into REIT shares. But it was a very significant transaction, very time-consuming, labor-intensive. And it's the second transaction that we've done in the last couple of years. We represented Missouri Valley REIT, which merged a couple of years ago with Edgewood. I'm sure you're familiar with that transaction. That transaction had 21 properties, but they were all owned by the REIT. But that was also a very significant. The interesting part about that transaction was we needed to have a shareholder meeting of all the shareholders of Missouri Valley REIT, along with a partnership meeting of all the partners in the UPREIT partnership. And it's the only transaction I've ever been involved in 37 years where we received unanimous approval to do the transaction of the, 300 shareholders and partners. So I'll stop there. I've been talking too much.
No, wow. I mean, that's really quite a feat to get that unanimous approval, for sure. So, all right. Well, Phil, just briefly touch on DSTs, since you've got the mic and you've done some UPREIT deals. You want to talk about some of your DST deals that you've been involved with and what that's involved?
Sure. This year has definitely been equity capital year, raising equity capital. We represent a number of developers that have been doing principally single property or, small groups of property portfolios, raising equity capital. But what we have seen is the DST market come back very, very strong. We are still doing TIC transactions, even though that market kind of blew up for syndicated TICs in 2009, 2010. What has really come roaring back are DSTs, which are Delaware statutory trusts, which are very similar in concept to TIC transactions. And the reason why they're important is an interest in a DST is considered to be real estate. So for purposes of 1031 transactions, you can 1031 your property into a DST. The interesting thing is we've seen family DSTs where properties are put in to provide flexibility to 1031 properties into other assets. We've also seen the syndication market go crazy for DST interest. And by syndication market, I mean broker-dealer capital that's available. I have one client where we've done 5 in the last 3 months, and the amount of equity capital coming in is there's not enough assets available in those structures for the market that the broker dealers are involved in. And interestingly, I know a lot of people in the room are dealing with REITs where 1031 money comes in and you upreit the property after or the day of in Fargo into the REIT. There's one REIT out there, a national REIT, where they're taking money, putting it into the DST, and there's a forced conversion of an upreit transaction into the REIT built into the entire documentation. So it's a very evolving area, and a lot of equity capital is available there.
Right, we're seeing a lot of DST deals too. I know we share some clients in that space. But for those who aren't aware of a DST, it's looks like a TIC, and I'd say operates more like an LLC. It just provides the flexibility of people to trade in and out of their real estate assets without having to do something like a drop and swap or something that's a little more aggressive in the IRS's eyes. All right, well, let's move on. Mike. Talk to us about Fannie and Freddie, what has changed over the past year, and tell us what we have to look forward to with those agencies.
Sure. So we at Bellwether, again, I said we're a national player. We're very involved. About half of our volume, loan volume that is done with the agencies, Fannie, Freddie, HUD. A year ago today, 10-year Treasury was below 1%. We had COVID reserves. So in other words, the borrower had to escrow 6 to 12 months of debt service into a reserve for fear of COVID. Rates were in the low 3s. And even with the COVID escrows throughout the year, Fannie and Freddie had a record year. Their volume caps were $70 billion, which they did meet. And mid-year, they released all the COVID escrows. And at Bellwether, we didn't have one single borrower withdraw. So that was good. So today, Fannie and Freddie are going to have about a $77 billion cap. So their volume is going to increase 10% with a huge requirement for affordable or workforce housing. In the earlier panel, they talked about workforce housing quite a bit too. And what does that mean? I get asked this question all the time. And it is actually a very complicated formula, but it's pretty simple on the back of a napkin. Is you simply just take your rent, and let's just say a 1-bedroom apartment is $1,000. And you all know what that means here locally. The assumption is the renter is going to pay 1/3 of their income towards rent. So if they're paying $1,000, they make $3,000 a month or $36,000 a year. Where that apartment's located at, there's an area median income. And if that tenant is at or below 80% of that area median income, you're deemed affordable. So in my little mathematical example that I just gave of a tenant who makes $36,000 a year on the rent assumption, and if the area median income is 50 grand, you're below that 80% threshold. So you're affordable. What that means is you're going to get 30 to 40 basis points off a conventional rate mortgage. So today, the 10-year treasury is almost 1.5%, and that converts back to a rate still in the low threes. So the expectation for where we're going to go in the next year is, especially in this market where you have the affordable, is the agencies are going to be very, very aggressive in lending on markets like the Fargo Moorhead area. HUD's not any different. HUD's mortgage rates, by the way, are below 2.5% for a 35-year fixed rate, fully amortizing loan that's prepayable after 10 years. Again, affordable. HUD's been very active in this market. 10 years ago, I don't think they did a single loan in this market. In the last couple of years, they've done actually 3 or 4. So it's a very, very attractive financing option. Again, targeted with affordable or workforce housing. That's a quick update on Fannie and Freddie. I'm gonna jump into a little bit of the DST real quick, because actually my firm has done quite a bit of DST financing. I personally have done over $2 billion in debt on DSTs. DSTs are very, very financeable. DSTs for multifamily, retail, office, industrial. The financing market is attractive. It's all done by CMBS primarily. The agencies will do some lending on DSTs. But the universal, where Fannie and Freddie, what I'm talking about doing 75, 80% leverage, the DST market's more like 60, 65% loan to value, 10 years interest only, rates typically in the mid threes. So there is financing readily available in the DST market.
Oh, sorry, I was on mute there. Apologize. So one of your questions to me earlier, Mike, is CMBS an option for borrowers in this market? Clearly it is in the DST area. How about other aspects other than DSTs?
Yeah, so the CMBS market, we lend, obviously I mentioned half our volume is Fannie, Freddie. We also do life insurance companies. We also do CMBS. Life insurance companies are a really good option if you're a borrower that's want lower leverage, typically 60, 65%. Where the CMBS guys come into play is more unique financing. I mentioned DST, but the CMBS lenders, they'll lend on office or properties types like office, retail, hotel, where Fannie and Freddie are only residential. Life insurance companies are lower leverage, larger, nicer quality assets, versus the CMBS groups, they're there to roll up their sleeves a little bit. They'll finance retail in today's environment where retail is still a big concern. They'll lend on office, which is a big concern still today. And they're actually starting to lend on hotels, versus a year ago today, there was no hotel financing available through the secondary market in my world. Now the CMBS market is starting to lend on CMBS. On hotel, excuse me.
Great. I think that's a really good answer. And we already kind of touched on HUD, that HUD is active in the market up there, and you see that probably continuing in the near future. All right, well, let's shift to Matt. Matt, how has the supply chain delays impacted construction financing?
There's 2 ways to look at this. I mean, you look at the existing projects that are already in place that started 12, 18 months ago, and then you look at the new projects going forward. But from the bank standpoint and the construction financing side, we're seeing on those projects that were started 12, 18 months ago, coming in 10 to 25% higher. Fortunately, with the way the market is with rents being higher, it's made up for that. So there's plenty of cases where new appraisals have warranted more borrowings on that project. From new projects going forward, we're doing a lot more due diligence on the front side, just lining up the income approach, pulling comparable properties, paying really close attention to the appraisal. There's a lot of cases where appraisals came in less than costs. Getting into the equity side, we're seeing more money down, more money in, and then released later in the project when stabilization takes place and along those lines. But the costs are significantly higher than they were 12, 18 months ago. Borrowers have adapted to it. There's a lot of projects that were delayed that's waiting for costs to go down, but we haven't seen anything like that. They're still starting to move those projects more forward, but there's a lot more due diligence up front. And in a lot of cases, there's a lot more equity into the project to make the project work at a better return. So.
Well, so with the increased costs, how are banks looking at construction financing? Are they requiring more down, or I mean, what do you see?
Yeah, I mean, with rates still relatively low, haven't changed much in the last 12 months. The rentals for multifamily or residential is probably went up, 25% since 12, 18 months ago. So it's warranted more costs, but there's definitely a lot more due diligence. We've had plenty of cases where we've had kind of cost studies required before projects are financed, just to line up with where the industry is at right now, and just put a lot more dependence on the appraisal, especially the income approach. But it's a lot of scenarios where for that project to work, it's a lot more money down. So we're seeing plenty of times where it's 30 to 35% down in the market instead of 25, which has been the case for quite a few years in the Fargo market here.
Okay, all right. I guess we've got about, I can't see it. I can't see the crowd. So we have about, 10 minutes left or so. I'm just wondering if the panelists have anything else they'd like to add, or we could certainly take some questions from the audience. I actually can't see the audience. So Phil, if you would.
We have about 25 minutes.
What?
We have 25 minutes.
Oh, well, hopefully there's some good questions out there. So, hey, I can ramble about anything for 45 minutes. Phil and Danielle know that. I don't think we want that, but, Phil, one thing that, you touched on in your outline are TIC deals. DSTs are similar to TICs. Are you seeing a lot of TIC deals, Phil and Danielle?
We are seeing a number of TIC deals. There was a period of time when everyone thought that TIC deals were gone, at least in my market, after the TIC industry blew up. But there still is a default to the TIC structure simply because it's well known by the developers and the property owners. So for example, we had a deal that was going to, it was going to be just a plain joint venture. And of course, the person contributing the property or the equity from the property decided they had to do a 1031 into the transaction, and their attorneys in California decided that it had to be a TIC transaction, and we needed to figure out a way to mimic the JV waterfall and equity structure. And it's interesting because the banks, I don't want to speak for Matt or Mike, but the banks typically prefer the DST structure simply because they're lending to one entity as opposed to having co-borrowers or separate individual borrowers, one person owning 90%, getting 90% of the loan, and the other TIC owner getting 10% and 10% of the loan. And despite that, people are still flocking to using the same old TIC documents that were put in place in, 2005, 2006, 2007. So it's interesting to see that those deals are still in place. I think as well, a number of the REITs still prefer using a TIC structure for 1031 money that they want to bring in as equity capital and ultimately have that uprooted into the REIT. So that structure is still there, still available. And then just to add on to that, I would say the equity money for real estate deals is amazing through COVID and through the early part of the year. All the REITs that I represent have been going out and raising equity capital for all sorts of purposes. And I've run across article after article talking about how much equity is available and has been raised by direct investments in the publications. So whether you're talking REITs or JVs or DSTs or TICs, the amount of capital that's being raised is off the charts this year.
Yeah, I would say I've seen a large uptick in people using TICs in the last couple of years. One thing to be really mindful of too that, Phil was kind of alluding to is making sure your agreement that you have in place for your TIC is a valid one. Something that I've seen a lot is, people treating a TIC like a partnership, having pref returns to people. And, you're setting it up as a TIC for a reason, more likely than not. So making sure you're setting yourself up for success on day one and making sure those agreements are read, by, Phil and your CPA or whomever is really advantageous because, undoing one of those things is pretty hard, to set yourself up for success in the future.
Which is a super good point, because I had that exact conversation Monday morning at 8 o'clock with a developer. The easiest way to think about it is, remember, the reason you're setting up a TIC structure is you're creating a real estate interest. You're trying to get away from creating a partnership. And the minute you put in the carried interest and the prefs and the steps, you're blending over and giving the IRS a good argument that you're a partnership, not a TIC. And Danielle's exactly right. You don't want to go through the brain damage of trying to figure that out when the IRS comes in and says you're a partnership. The other thing I would say is the economics of partnerships have changed slightly with the cap rates coming down. I know everyone here is dealing with that, but the common deal in the JVs was an 8% pref, return of capital, and then 80-20 carried interest or promote for the developer. And what we have seen is, this isn't universal, but a lot of people have gone away from the stated 8% return. You'll see it in the models and in the projections. That's what they try to return, but you won't see it in the LLC agreements as a stated accrued preferred return. What you'll see is IRR returns. So it's pro rata up to a point, up till you hit 13 IRR, and then it changes up to 18, and then it's a different split after that point in time. And I think the reason being is everyone knows that getting to 8% is a lot harder than it was 5-6 years ago, given the cap rate change.
Phil, Danielle raised a good point, and I appreciate your, comments on that, trying to get creative and do allocations. Does a DST allow you to, give you some of those preferences maybe that you couldn't do in a straight TIC, maybe certain allocations of certain items, or some preferences? I mean, does...
So
Go ahead.
Given that I've done a handful of DSTs on the financing side, typically your DST investor is a 1031 investor, call it mom and pop operator, maybe sold a restaurant, sold whatever asset they sold, and they get 1031 into a DST. Most of those investors are just getting a flat fixed return. The procurer of the DST, they're going out there acquiring assets, whatever. They're going to charge an asset management fee. They're making their money that way. The investors themselves, they're designed to have just a flat return for the life of the DST. So one of the things that lenders like on the DST versus a TIC structure, I'll highlight that real quickly, is most DSTs are structured with what's called a springing LLC. So with the TIC, let's just say something goes bad. And everyone in this room has one share of the tick, and the deal goes bad, it needs capital. The problem, one of the problems with the tick is if I'm the procurer of the tick, I have to come out to every single one of you and say, everyone chip in 10 grand to fix this. And all of you run out the door. That's the problem with the tick. So with the DST, it's not much different other than the DST has the ability to convert itself to an LLC. It's called a springing LLC. The springing LLC, then you can actually go out and raise capital, either equity or debt, to fix the problem. Once you fix that problem, you can convert yourself back to a DST, so you still save that 1031. So that's one of the reasons why a DST is preferred in the financing world versus a TIC.
Well, that's really great information. Matt, can you talk to us about some of the projects that you financed recently? And that's my mighty pug in the background here, so I apologize. So, Myrtle.
Got to be a little careful, but there's been a lot of, I would say, multifamily projects has been a majority of, I would say the Fargo market's extremely strong for that, has been. Vacancy is very low, is what we've seen over the last 12 months with the increase. That's been a lot of the major projects. There's actually been some office buildings and we've seen success with lease up on those, some Class A buildings that have worked really well. We're still seeing some of those larger tenants looking for nice, desirable space, and there's very little Class A space in Fargo. And then the contractor side has been extremely strong. As we know, the Fargo market's been very good for construction for years, and especially over the past couple of years. A lot of those contractors were busy throughout last year and got their share of PPP funds and building their own buildings type of thing. So on the industrial side or commercial side, we're seeing a lot of owner occupied type buildings going up in Fargo as well. So.
Okay. Mike, you do it. Yeah, go ahead, add on.
I don't get to talk to bankers very often. So, so I think it was Bernie, who was the mayor of West Fargo. He mentioned an increase in, was it commercial income, retail income relative to real estate? So are you seeing bigger, larger, more developments in, he was West Fargo? I'm just curious what that means. I didn't quite understand that. It sounded like it was new construction. I figured you'd know more about that.
Well, on the West Fargo side, there's been some larger projects downtown, mixed use, and as well as out where the lights project, what they talked about with Bernie talks about with Epic Group, and then the Eagle Ridge Group as well, built some large projects out there. It's been a lot of mixed use probably over on the West Fargo side, I would say, more than anything. The residential is filling up. Burning or Epic is doing some condo projects over there. He really built a nice project with a lot of amenities, and I think he's doing something similar on the Fargo side on 45th Street as well. So the mixed use, there's been quite a bit of that, and then the multifamily, as far as with a lot of amenities, we're seeing a lot of that, and we're looking for a lot of that with our new projects we're financing. Just the days of the 36-unit apartment building with nothing in there, but the apartments are pretty much done in the Fargo market. There's everything's built with, a bunch of different amenities to cater to what everybody's looking for.
When you say mixed use, I think mixed use, I think retail on bottom, multifamily on top. Is that true? They're the same, or are you seeing different types of use?
Yeah, more of the retail on the bottom. Light retail, I would say. There's a couple of projects that are going up now that are looking for more like the bar types and a little bit more heavy retail, I would say. Some office in there as well.
And I know downtown, the Bank of the West project and the opportunity zone, there's a lot of interest in that area right around there. And then there's the improvement or redevelopment, a tax credit redevelopment area of the building just to the, what would it be, south of Bank of the West building. I know that area is significant involvement, and that's more on the commercial side.
Okay, now we have 12 minutes left. And so I was just wondering if the audience has any questions or the panel wants to add anything more. But Phil, if there are any questions, would you mind fielding those? And we'll go from there.
Sure. Any questions? Seeing none, unless you have any last words.
Can we talk a little bit more about inflation?
Yeah, the question was, how do you think inflation might affect the markets? Do you want to take that first?
I can take a stab at that. I mean, inflation, I struggle with the word inflation right now because I really don't know what it means. For comparing, the doldrums of COVID versus today. Is inflation going to increase rental rates? And if it increases rental rates, is it going to increase value? I think that's a question in time that'll get answered. I mean, we, on our financing side, we have been seeing increase in rental rates on our lending, and we've seen increased values in properties, and we've seen increases in our loans. So I think that's expected to continue into 2022, 23. I just don't know where it ends. So the answer on my side of it is, yeah, we've seen it. Rents have gone up, values have gone up, our loan proceeds have gone up. And I think that's going to continue to trend into 2022 and possibly 23.
I would just add the obvious. You've got real estate taxes going up. You've got material costs going up. You've got rents going up. It just makes everything more expensive, which means and Matt indicated that the need of equity capital in the deal is going up as the amount lent is being decreased as a percentage of the deal. So that just means you're going to have to raise more equity capital. And given that the cap rates are so low, it makes it harder to make these deals work from a pro forma basis. Now I'm talking big picture. Obviously, each deal stands on its own merits, but that would be my thought.
The hard part about that, your comments is the expectations the rates are going to go up. So that's yeah. So you have increasing costs, increasing values, increasing rates, increasing rents. So that's part of the challenge right now.
If you can find the workers to build the buildings.
Rates.
Well, rates are about the only thing that hasn't went up in the last 12 months. I mean, and actually behind the scenes they have since about the first of the year. The banks typical in the community banks in Fargo are borrowing off of Federal Home Loan Bank rates, typically 5 years, call it fixed. Our indexes went up 75 basis points. And if you look kind of pre-pandemic, so to say, 2 years ago, our rates are within 0.25% through 30 basis points of where they were then. So what's happening is banks are so full on cash, and from the past 12 to 18 months with PPP fees, and everybody's strong on capital. So it's been competitive. Banks are holding the rates down. So we're offering the same type of rates today as we were 12 months ago, and when rates were 75 basis points less. So our margins has went down on these projects, and just have to say how long that trend will continue.
I'll echo that within the Fannie and Freddie. They made a comment. So Fannie and Freddie's volume cap was 70 billion. It's going to be 77 billion this year. The 10-year treasury a year ago today was below 1%. The 10-year treasury today is about 1.5%. So 50 basis points increase in the 10-year treasury, but the all-in rate from a year ago today is within 10 basis points. So which means spreads have gone down throughout 2021.
And I guess I would just comment to the type of projects that we're seeing on the development side. Our firm has done hundreds and hundreds of affordable housing deals over the last couple of years. We represent a couple of the largest developers in the country. But on the equity capital side, where we're seeing most of the money go, obviously, is multifamily. Multifamily is still very, very strong. Industrial is still very, very strong. We just formed a $100 million fund and it was sold in 2 weeks. So the money is still available on the industrial side, somewhat of a pedestrian sort of return, but people are looking at that safe sort of investment.
Any other questions? Or you see it?
I see we've ginned up a lot of excitement.
Well, tax and financing, if that won't do it, right? Well, if that's it.
Why don't we
go ahead.
finish it? No, why don't we finish it up and can have a little bit longer break? Thanks, everyone.